the ETF Corner today, we've been bringing out this whole theory of why one should be investing in index fund. Index funds in this kind of a market perhaps could be a reasonably safe option to invest. Markets, they may not history may not repeat itself, but it certainly rhymes, which is that we've seen many booms and many busts in the past, and we've seen many crises. But each time when you've acted wisely, smartly, and intelligently at a time on crisis when pessimism is at its peak, you've handsomely benefited because of that. One very basic benchmarking tool of valuation which some of the famous investors like Warren Buffett have used is market cap to GDP ratio, which is that you look at the market cap of the country and market cap of the stock market and the GDP of the country. And each time this ratio has gone below 0.75 or 0.5, and if you've invested in the index, the returns in next 12 to 18 months are quite handsome. Some data points will just come up on your screen which will in a sense signify and indicate that every time you've bought index or Nifty stroke index funds, when the market cap to GDP slips below 0.7 or 0.8, you are rewarded, and you are rewarded in the next 12 to 18 months. So Kunj, I'm asking a fund manager to comment on index investing, but history tells us that if you've bought index, which could be called as a safe and a reasonable option, and perhaps a reasonable way to start rebuilding your portfolio, and every time when you've bought the index, when the market cap to GDP goes below 0.7 or 0.6, within next 12 months you are handsomely rewarded.
Yeah, so multiple ways to look at it. One simple thing is, as they say, lies, damn lies, and statistics. Continuing with that, the numbers, the data, the statistics, the charts can be put up whichever way you want to put them up, and draw your inferences and conclusions accordingly. Having said that, I fully agree with this broad basic data points that are there. What I would like to add here is that despite the fact that you are buying a market at a market cap to GDP of whatever X number and below, you have to be ready for two things. One, that it can further fall from here. You are buying at an X point doesn't mean that that's the bottom. Nobody is generally able to catch the bottom. Depending on how things develop, how the news flow develop, how actual developments happen, you should be ready to see further downfall. If you have money, buy more at the downfall is a no-brainer advice that is always given. So that's one. Two, you can't have a timeline. It might take, depending on the crisis that you are going through, depending on the development that you are going through, it might take a while before the recovery comes in. So as long as these two things are there, yes, this is a safe strategy. This is a well-advised strategy. This is a well-proven statistically. Now, just one more point that yes, one can do index investing strategy also. At the same time, why not do non-index investment strategy also? It works both ways. The index strategy, at least till a while back, or let's say till this corona came in, or even keeping that corona aside, was more applicable to developed market, wherein it was really difficult to find good investment opportunity which in the financial performance were outperforming the growth rates of those economies. That was not the case, and that will continue to be not the case with the high growth economies like India and some others, wherein you will continue to find the investment opportunity, the sectors, the companies, which will continue to grow at a far higher growth rate than the economic growth rate. And if that continues to be the case, their share price performance will obviously outperform the index or the market. So it's both ways. This strategy, while it is certainly good for index investing, it is good for direct non-index investing also.